Hi guys, so in the last video we talked about the importance of being able to anticipate growth in GDP. And the reason we do that is to have our bullish or our bearish predisposition towards the financial markets. The next step in our stock selection process is to actually drill down into the industry. And the reason we're doing that is, first of all, once you've got your predisposition, what you could be doing is simply taking a long or short position in a particular country's benchmark index. So if you like the state of the US economy right now, you could simply buy the S&P 500. With the UK, you've got the FTSE 100, and then you've got your Euro Stoxx 50 for Europe. But what we actually want to do is outperform the market, right? So rather than just buying the benchmark index, we want to find an industry that's going to outperform the market. And likewise, we want to find the best stocks within these industries that outperform its peers. So to do that, what we want to be doing is taking our predisposition and leaning towards either cyclical or defensive sectors in respective stocks within each of these sectors. Now, let me just give you a definition. So cyclical stocks are companies whose earnings are very sensitive to the current economic cycle. And what I mean by that is whether or not the economy is growing or contracting, right? And a defensive stock is one whose company earnings are very stable regardless of the state of the economy. So to give you an example of both a cyclical sector would be your consumer discretionary or your financials. The flip side, defensive sectors, you could be looking at consumer staples, or you could be looking at utility companies. And when you get company specific, if you're looking at cyclicals, high-end retail is a very good example. So you'd expect a high-end retail store to be performing very well when people are spending money, and not to perform as well when we see a contraction in the state of an economy. So when people are holding on to the pennies. An example of a defensive stock would be someone like Procter & Gamble. So their product offering is household specific, things like toothpaste, household cleaning products. Something is always that consistent demand for. Another example would be your energy providers. So when you're trying to find either a specific sector, industry, or stock that's cyclical defensive, back in '99, the MSCI and S&P came together and put together a classification system to standardize what stocks make up particular industries and which industries make up a particular sector. And they also classified cyclical and defensive stocks and sectors. So what I've done for you on the website, on the Trading FM website, there's a screener that allows you to search for companies specifically within stocks, industries, or whether or not they are cyclical or defensive. And this is very much focused on all your large caps. So I look at the S&P 500 stocks, the FTSE 350, and the Euro Stoxx 600. And we'll go through that in a bit more depth when we jump into the computer. Now, leaning towards cyclical or defensives is a great start when picking our industries, but we want to pick industries that are going to outperform, right? And there's really three things we can look at. The first thing for me is to look at the ISM reports on business, specifically their qualitative statements that are industry specific. Second thing I'll look at is the economic cycle. Now, when we look at economic cycle, there's four phases. There's your early expansion phase, mid expansion, late expansion, which is where you see your growth rates tapering off. And then you've got your contraction phase. So that's when an economy is in a recession. There's been a lot of research into this space, into economic cycles. First of all, be aware that it's not an exact science, right? So determining where we are in an economic cycle, what we can do is we can look at some economic indicators. So we can look at GDP growth, we can look at interest rates, we can look at inflation to help us determine where we are. And once we know that, there's been a lot of research done into which industries perform best within which phase. So I'll show you on the site a ranking factor. So determining what phase of the cycle we're in, we can look at what industries have historically outperformed or performed best, and use that to help steer which industries we want to be looking at. The third thing I do is if I'm looking at the US, I'll look at the earnings growth rate. So looking forward, I'll look at the earnings growth rate of every stock within the S&P 500. I'll then categorize all of these stocks into industries and sectors. And what I'll do is I'll take an average. So I look at the average growth rate across sectors and then specifically with industries, and that really helps steer me into which industries I want to be looking at. because it's earnings growth rate that really kind of drives stock performance. If a stock's earnings are growing, its financials are good, I'd expect stock prices to go up. So that's the third thing to look at. Now, let's jump into the computer and we'll go through some of the resources I've made available. Hi guys, so the first thing we want to do is jump onto the Trading FM website. That's tradingfinancialmarkets.com. And once you've signed up, logged in, under the Market Fundamental tab, you'll see we've got the industry section. And what I've done here is created a resource for you. So I've broken down stocks into the relevant classifications, whether that's cyclical or defensive, and I've also categorized them into industry and sector based on the GICS classification scheme. So let's just jump into the S&P 500 for start. You can see here you can quickly refine your list of stocks within particular sectors or particular industries, right? So let's say we have a bullish predisposition towards the markets and we're leaning towards cyclical stocks. What I want to do is look at the cyclical sectors, so that is consumer discretionary, financials, industrials, information technology, materials and real estate. You can see what this has done is simply refined the S&P 500 from 505 stocks down to 337. Still a pretty chunky list, so you can then further refine it by industry. So let's say you want to take a look at airlines. You can see we've now got 5 S&P 500 companies refined down to a particular industry. I previously said there was 3 things I look at when deciding what industry to drill down further into. And the first thing is to look at the ISM reports on business. So if we jump into market fundamentals under the United States, what I will do is, I've got the data source just available here. I would look at the qualitative statements in the most recent PMI report. So if we look at the manufacturing report, scroll down quickly, just taking a look at this. So if we look at miscellaneous manufacturing, we've had a lot of storm orders, so really pushed up our sales this month. That's a bullish statement, so I might want to explore that industry further. What I would do is then look at the miscellaneous manufacturing sector. One thing to bear in mind is that the ISM reports use a slightly different classification scheme. They use the NICS, so I'll just show you some premium content. If we go to bonus content available, what we could do quickly is take a look at the miscellaneous manufacturing, and you can see here this is the 9 stocks that I'd be wanting to look at just based on this qualitative statement. These are 9 stocks that I would look at further. Next thing I do is look at the economic cycle. So again, this is premium content, but what I want to show you is how to determine what stage in the economic cycle we're at. So there's a lot of research out there about economic cycles, and from the extensive reading I've done on the subject, I've created these illustrations to best simplify how to determine which phase in the economic cycle we're currently in. So look at 3 coincidence indicators. We look at interest rates, inflation rates and GDP. We look at interest rates because it's the tool used by your central banks to essentially stimulate an economy or tackle the rate of inflation. We look at inflation because of its importance in basically measuring the general increase in prices and fall in the purchasing value of money. And then we look at GDP because that is the measure of economic growth. Scrolling down here, what I've done is consolidated the information we need into one place. So looking at the US, the EU and the UK, what we've got here is the economical data to hand. Now this is readily available on the internet, so all you need to do is a little bit of research to find this. If we look at interest rates at the moment, we can see that we have started to see interest rates creep up. So if we use this illustration, a slight increase in interest rates would imply that we are currently looking at the second phase, the mid-expansion phase. We then take a look at inflation rate. A couple of things to note. So first of all, the typical measure for inflation is the consumer price index. However, the US Fed actually look at the personal consumption expenditures inflation measure. So this is what we're looking at here, the PCE. And the target is 2%, so that's the ideal inflation rate that the Fed wants to achieve. So bearing in mind that we've been sitting around the kind of 1.7, 1.8 mark, and based on the target of 2%, I would say that we're sitting in phase 2 at the moment, so mid-expansion. And then looking at GDP, just come across one more. So looking at the growth rates, you can see here in kind of end of last year, we were at 3.5%, 2.1% growth rate. So that's quite a good GDP growth rate, and that's annualized. So yeah, it would say kind of 1, 2. So I think looking at mid-expansion phase is a pretty fair assessment there. The next step then is to look at the relative performance of each industry. Now, these ranking factors here are based upon the business cycle sector research done. Okay, so we can see here, looking at early expansion phase, I've put a small c here for cyclical and a D within the brackets for defensive, and you can see that your top 5 sectors are all cyclical and your bottom 5 are all defensive in terms of performance in the early expansion phase. And then when we look at contraction phase, it's typically defensives that outperform rather than cyclical. So we can use this to help steer our selection process in terms of what industry to look at before drilling down into stocks. And that's essentially what I would do for economic cycles. So the third and final thing I look at, going back into premium content, we've got an industry overview for the US. So this is a complete overview of the earnings growth rate for every single S&P 500 company. It's then categorized into industry and sector, and I take an average of each. So if we look at this, we can see right now materials, financials, information technology are the cyclical sectors that are looking to outperform. And then we've got, from a defensive side, we can see energy here has got a massive earnings per share growth rate. Now the reason for that is because, if you recall, we had a huge pullback in the price of oil, and it wasn't until kind of 2016 that we started seeing stabilization of your oil price around about the $50 mark. So oil pulled back from over $100 a barrel, went as low as $26 a barrel, and now we're kind of seeing it stabilize. So energy companies took a massive hit. They would have had negative earning growth rates. There was huge cutbacks in the industry, and now we've started to see stabilization in the price of oil, as well as it coming back up. That's reflected in the earnings. So this 160% EPS growth rate, that's year on year. Okay, going from negative earnings to positive earnings is going to give you a big percentage increase in the EPS growth rate, which is why this is so drastically different from every other sector that we're looking at. This is why it's 3 digits rather than 1 or 2. And then if we look down, we'll just drill down into that a little bit further. So we'll look into the energy sector. So there's 2 main industries. You've got your oil and gas, and then you've got your energy and equipment. And you can see here this average EPS of 185% is across 29 stocks. So I use this information on top of the economic cycle analysis, and as well as the ISM reports on business, to help me determine which industries I'm wanting to drill down into further to pick the best stocks within that specific industry. Now we've covered a fair bit, so what I've done is recently launched the Trading FM forum, and I want you guys to ask me anything about what I'm teaching you in these videos, okay? So once you've signed up, you'll see here I've created the Ask Me Anything, and so if you've any kind of questions about what I've discussed so far, jump into the forum and feel free to ask your questions here. And you're more than welcome to ask any kind of general questions around about stock trading. Okay, so next video we're going to dive down a little bit deeper into stock selection process by actually looking at some of the metrics we need to use to find both the best and worst stocks within each industry.